Good afternoon, ladies and gentlemen. My name is Michalis. I'm one of the markets analysts here at HF Markets, and I'd like to welcome everybody to another webinar. We had a great webinar yesterday. We had a lot of questions. We had a lot of great feedback. We had a lot of debates about yesterday's topic, but we're moving on to a different topic. Now, this is a topic that we looked at back in December. We looked at risk management for individuals with experience. And we had a lot of great feedback that it was very helpful, advanced risk management strategies, and so on and so forth. But we had a lot of individuals also come and say, it was a great webinar, but it was very advanced, and there was a lot of things that as a beginner or as somebody who has never traded, there's a lot of things there which I couldn't use. So today we're looking at risk management again as a topic, but we're looking at it in a very basic approach. So as a beginner, so somebody that has been trading, a month, should we say, for an example, or somebody who has never traded before in their lifetime, how can they approach risk management? So we're looking at, for example, the first steps into risk management. Now, after yesterday's webinar, we had a lot of questions. Of course, yesterday's webinar was not based about risk management, but we had a lot of questions, and they were great questions, by the way. So what we've done is we've also added that to today's webinar, but we've related it to risk management because we had a lot of questions in regards to entering trades, the timing of entering trades. We had a lot of questions in regards to what price to enter trades at, and so on and so forth. So we're going to look at that also today, because I did promise yesterday that we would look at it, but we're going to relate it to risk management. So today, ladies and gentlemen, we're going to start off with a very quick introduction like we always do. So as part of the first slide, very quickly, I just want everybody to be aware that, of course, these webinars are here for educational purposes. They're not here to give direct investment advice. What we do want to do, though, is to give you as much information as possible, educational material as possible, in order for you to be able to achieve your goals and to be active in the financial trading markets and attempt to go to those pillars with confidence, with knowledge, and with expertise. So yes, we're not here to give investment advice, but we do want to provide as much educational material as possible. Now, the other thing I want to say as part of this slide, the very last thing, is that, of course, when we're looking at trading, trading is, of course, a form of investment. And as with all investments, there is a risk to the capital that you are investing. So it's important that we understand this. It's important that we're comfortable with this before proceeding to a full investment. Now, if you have read what is on the screen and you've gone to our website and you've read through various pages on the website and you still don't understand what risks can potentially be involved in an investment, any investment or this specific investment, then of course you can get into contact with us and we will provide you as much educational material and the information required as possible. I did get somebody yesterday ask a question on this actual slide, and he said, why is there risk involved? And we have to think about, when we're looking at an investment, we of course are speculating a direction in the market. So for example, if we're looking at a specific stock, it could be, for example, Nvidia stocks, which have been very popular over the past 18 months. If you're looking at a stock, you are speculating a direction. You, of course, are either going to speculate the price is going to increase or the price is going to decrease. Or you can do both, of course, which is known as hedging. But of course, we have no control over how the market is going to move. So of course, if you're speculating that the price is going to increase but it decreases, then of course that is the risk which is involved. Now, what we want to do, like I've already mentioned, is we want to provide you with the knowledge in order for you to be able to analyze the market and look at the market in different ways in order to predetermine how the market potentially is likely to move. So of course, this is what we want to do. Today, though, what we're going to do is concentrate on risk management. Now, this is the last slide before we go to looking at today's topic. I don't want to spend too much time as part of this slide, but like I always mention, it is important to know a little bit about the individual who provides you with this information. So a bit about my background. My name is Michalis. I am one of the market analysts here in the head office at HF Markets. I have been in the financial trading markets now for 10 years. Originally started off as a financial advisor. That was in London for approximately 4.5 years. I've been a market analyst since then for a further 6 years. And again, I don't want to spend too much time as part of that specific slide, but what I really wanted to do is to give you a bit of information about myself. And the main thing I wanted to get across, the main message I wanted to get across is that, of course, these webinars are not necessarily just a presentation. Today, of course, we have a presentation. It's not a live analysis webinar where we're on the real live trading markets and the MT5. This is a webinar where we're looking at a presentation. Even so, it's not a lecture where you sit down, you make notes, and that's the end of the lecture. There's nothing else involved. Webinars, ladies and gentlemen, is a great opportunity where you as beginners or as traders or somebody thinking about investing in the financial trading markets have the ability to ask questions. Tell us about your experience. So there is a Q&A section on the GoToWebinar software. Of course, you can ask questions about something we're speaking about. Maybe you have experienced something this week and you wanted more information about it. Maybe you found something very difficult or you found something very helpful and wanted to share and get more information on it. Of course, this is a great opportunity now in which you're able to do so. So the first slide, aims of risk management when we're looking at trading. Now, what I want people to, of course, keep in mind is that today we're looking at risk management for beginners. So we're thinking about somebody who's not even entered into the market yet, but is thinking about entering or is about to enter, or somebody who has very recently entered into the market and yet hasn't included in any way, shape, or form risk management techniques as part of their analysis. We're going to look at the basic methods, things that people can do very quickly, very easy to understand, very easy able to put it into your trading plan. What are you able to do from day one as beginners? This is what we're going to be looking at as part of today's webinar. Now, of course, what is the aims of risk management? And a lot of people are going to think to themselves, I know the answer to that. Of course, we want to limit risk, we want to mitigate risk, we want to spread risk, etc., etc., etc. But it's not just about that, ladies and gentlemen. It's not just about, I'm opening the trade, let's put a stop loss at this level. Of course, yes, we are going to look at stop losses and different types of orders. Yes, okay, they can be helpful, but a trading plan and a risk management plan is also about mathematically, how can I look at my trading without any emotions in any way, shape, or form, and look at it and mathematically be able to say, how am I able to look at this trading and take this trading to the next step and take me from an individual who is experiencing losses or is experiencing, a mixed performance and take that into a successful trader. This is what we're going to look at as part of today's webinar, because at the end of the day, even if somebody is unable to determine how the market is likely to move, let's say somebody's just entered into the market, they have no idea how to analyze the market. They are definitely not able to determine how the market is going to move. How can this individual still be successful? And it's all about mathematics, it's all about statistics. Today, we're going to look at a very basic way of how you can take your trading and the statistics around your trading and use that in your favor to ensure that you're successful at the end of the day. And of course, you're only able to do that if you're looking at the statistics. And I'm going to show you exactly how to do this in the later parts of the webinar. Because numbers don't lie, ladies and gentlemen. If you look at your statistics, you can look at it and say, This is what is needed in order to the way that I have been trading over the past month that I have been trading. This is what needs to be done in order for me to be successful. And it's not a matter of, I need to be able to determine how the market is going to move. It's, I need this to happen based on the way that I've been trading so far. So mathematically, this is what is required, okay? And like I said, mathematically, numbers do not lie. I'll show you exactly what I mean. A lot of people are probably looking at this and thinking to themselves, I don't know what he's talking about, but please bear with me and you'll know exactly how you're able to use statistics and mathematics around your trading and around the risk management plans that we're going to show you in order to ensure that you're going from a trader experiencing some losses or a trader which is at the break-even point in what is required in order to turn that into a successful trader. So what are the aims of risk management? This is just to get people into the idea of what needs to be taken into consideration. So you've just entered into the market, what needs to be taken into consideration? So ensure, as part of the risk management plan and part of what we're going to look at today, we want to ensure that exposure is not a risk to your account. A lot of people that I speak to, we of course have one-on-one sessions occasionally, sometimes as well. A lot of people that I speak to, they say to me, I've opened a couple of trades and now my account is in danger. I've got a margin call or my margin is slightly low, whatever it may be. This, ladies and gentlemen, is unacceptable. This is something which should never ever take place. Very simply because your risk management plan should ensure that exposure is not an issue. So this is something that, of course, we're going to aim for as part of risk management. So ensuring exposure is not a risk for your account. Point number 2, ensuring that your trading plan is mathematically able to ensure that you have successful cash flow. This is exactly what I was referring to before. It's ignoring analysis, taking analysis out of the market, taking it out of the market. When am I going to enter? Is the price going to go up? Is it going to go down? Is it too expensive? And so on and so forth. We're ignoring that and just looking at the mathematics around your trading and saying, based on these numbers, this is what needs to happen in order for me to be successful. Okay, this is something that we're going to look at. We're going to look at real examples as well, ladies and gentlemen. Ensuring no outcome is unexpected. Nobody should be opening a trade and saying that's a higher loss than I previously was expecting. Nobody should ever say that. Nobody should even ever say that's more than I expected to earn. If you're earning more than you expected to earn, you could have lost more than you expected as well, which is in either way, shape or form, not something which is acceptable as a trader. Everything should be controlled. Okay, even profit, it should be controlled, because if your profit is controlled, any potential risk is also controlled. Okay, so this is the way I want people to start looking at the market, because of course, as you know, I've got a background as a financial advisor as well. I want people to start looking at the market in an institutional view. So how do institutions and how do institutional traders look at the market? Nobody in JP Morgan or Goldman Sachs, for example, is going to come out and say, I didn't expect that to happen. It will never ever happen, and it shouldn't happen for us traders, and it shouldn't happen also to beginner traders. So this is why we're providing this information, and we're going to show you as well how we're able to ensure this step by step. Ensuring analysis is accurate and possible risks have been identified. Ensuring knowledge and skills are able to improve as a beginner as we gain experience. This is something which is very important as well. What I want people to also be able to do is to ensure that their experience and their knowledge is gaining at a fast pace. And a lot of people I speak to, as I mentioned, I do a lot of one-on-one sessions, and as part of the one-on-one sessions, of course, we look at their traded history. And they say to me, I'm not getting a better understanding of the market. Month 1, I had a 50% success rate. Now I'm on month 5, and I still have a 50% success rate. I don't feel like I know the market more than I did. So what is the issue? Why am I not learning with experience? And there's very clear reasons why not. And it's very easy to ensure that you are learning and you are getting experience and you are improving. And this is something that we're going to look at today as well. The last thing as well, we're going to answer questions because I can see 2 questions here, and I'll answer that after this point. Provide appropriate tools to trade with conditions in your favor. This is something which, of course, also is part of risk management. So I've got some questions here. Question number 1. I've got a private question as well. So just so you know, I also read out private questions, but we never expose any sensitive information. So nobody, of course, knows that it's you that's asking. Somebody says, how can you use statistics and mathematics to know the outcome? This is something we're going to look at in approximately 4 slides, okay? I'd rather not answer the question. I'd rather show you. And if you still have questions, we can, of course, relook at it at that slide, okay? But I'm 100% certain that when we look at it on the slide, and I show you step by step what needs to happen, it's in approximately 4 slides. Probably the most important thing as part of today's webinar as well. Is at that point, you'll get a good understanding in terms of what I'm referring to. I've got another question here. So I've got somebody who says that he's a beginner trader and he needs a step-by-step guide on trading. He's given some more information, not necessarily relevant, and I don't want to expose it because he's mentioning some of his personal money as well. Look, if you're a beginner trader, you're not going to get all the information you need as part of this webinar alone. You need to watch continuously more and more and more webinars. He's mentioned he's in a demo account. That's great. He's able to practice as part of this account. This webinar is going to be extremely important for somebody like this gentleman who has never traded. Very important. There's going to be a lot of tips throughout today's webinar, but keep in mind, you're not going to get all the information in this webinar's 50 minutes, okay? But if you go to YouTube, you type in HFM or HF Markets, either of the 2 is fine. Go to our page, subscribe, go to videos, go to the list of webinars. You can see there's many, many webinars. There's webinars like today, which is risk management. There's webinars with strategies, trading approaches, methodologies, trading journals, trading plans. There's everything there in terms of education, which is possibly required. But today's webinar is really a great step because, of course, it's really looking at the first steps to take as a beginner. So first steps as a beginner towards risk management. Now, like I said, and also this was something which I spoke to somebody yesterday about. He said to me, month number 1 that I've ever traded, I had about a 50% success rate in the market. So if I opened 20 trades, 10 of those trades were in a profit. Now he was on month number 5. So it was his 5th month in the financial trading markets. And he says, I've still got a 50% success rate. I said, okay, just so I've got a good understanding and know a little bit more about your trading, let's go through your trading history. And that gave all the answers in terms of why he's not improving as a trader, why he's not learning. He was trading approximately 30 assets. Every single day he would trade a different asset. He would trade at different times, different days, different sessions. He would trade sometimes during news. He would trade sometimes where there's no news at all. He would trade on bank holidays when markets were closed. Sometimes he'll trade overnight. Sometimes he will close trades very quickly. Sometimes he will trade the trend. Sometimes he'll fight the trend. And that, ladies and gentlemen, was the reason why. Very simply, you cannot improve as a trader. Also, I mentioned yesterday on the webinar, when we're looking at Bloomberg and watching economic news, they always have analysts and traders and strategists and economists come and speak about certain things within the market. They may speak about the NASDAQ, they may speak about the US dollar. And they always provide their name, the company they work for, and their title. And you always will notice that you never have somebody who's analyzing the whole of the market. It will be, for example, chief strategist, US stock market, chief strategist, the NASDAQ, chief strategist, the US dollars, FX strategist, for example. You'll never see somebody that's analyzing Japan, the US, commodities, FX, the stock markets, and so on and so forth. So why, as traders, am I today trading the New Zealand dollar because there's a lot of volatility there? Tomorrow I'm trading the NASDAQ. The day after that I'm trading gold, and so on and so forth, because every single asset is different. What's influencing the asset is different. The traditional price movements of the asset is different. The way technical indicators are reacting to the asset is different. So if every single day I'm trading a different asset, every time I switch an asset, I am very simply starting as a beginner again. So after 5 months, if I'm trading an asset for the first time, I'm a beginner again. Okay, so I'm never going to improve. I'm always going to be stuck in that same scenario. So this is something, of course, we have to take into consideration. And also we have to take into consideration that there's 3 different sessions. Some people say there's 3, some people say there's 4. Technically speaking, okay, there is 4. But as beginners, let's say for argument's sake, there's 3. Each asset at different sessions reacts differently, okay? So we also have to take that into consideration as well. So if we want to improve and be more successful traders and improve our success rate, we need to, of course, get more experience, okay? In order to do so, the best way is to trade one asset. And ideally, to trade that asset during one session, the same session. So for example, I may trade the NASDAQ, let's say for an example. I'm trading the NASDAQ. I trade the NASDAQ, I trade nothing else, and I only trade it in this session, okay? Or it may be only during these 2 sessions. In 6 months' time, I'm gonna be a much better trader because my knowledge of the NASDAQ during that session is going to be vast, very strong. My experience, my expertise is going to be much stronger, okay? Whereas if I'm trading a million different assets, I can't manage that. Even me, as a very experienced trader, will never be able to do so. And a good example as well is if somebody goes out there and speaks to fund managers. Even in the CFD market, there's many, many fund managers, okay? You will never find a fund manager that's trading different assets, okay? I've worked with fund managers a lot, and fund managers, okay, will trade one asset, okay? Maybe 2 assets at very max. So you as a beginner should definitely consider potentially trading only one asset, especially during the very first stages when you're building experience, building education, and so on and so forth. You can see a lot of questions. What is a session? A session, ladies and gentlemen, is you have to take into consideration, of course, different areas around the world have different time zones, okay? Each zone will have specific hours where traders enter the market, okay? Some markets are 24 hours, okay? So for example, the FX market is 24 hours, all right? But traders will still become more active during when the market is open. So for example, in America, where the US trading market is open, which is when the US stock market is open, all right? So of course, when you're looking at a US asset, so an asset which is based in the US, when the US market is closed, all right, and it's in the middle of the night, and you're in London, of course, there's not going to be a lot of volatility. And of course, there's going to be very weak price movement. Okay, and it's going to be difficult to analyze that asset. Why? Because in America, it's 4 o'clock in the morning. Nobody's trading it. All right, the market is closed. So this is what I mean by sessions. There's different sessions. There's the US session, there's the Asian session, the London session, and there's the European session as well. So hopefully that answers that question. Stop loss, take profit, and trailing stops. Now, this is something, these are free tools, very basic free tools that people can take into consideration when they're trading an asset. Again, an asset, not 10 different assets. And keep in mind, we're not giving any financial advice. This is just here for educational purposes. Of course, if you want to go and trade 1,000 different assets, of course, you are more than welcome to trade 1,000 different assets. And of course, let us know how that's working for you as well. So let's say we're analyzing the market. We can see a trend, okay? So let's say, for example, the price is increasing in value. We're seeing what is known as higher highs. So we can see one high, a second high here, and we can see lower lows. So we've got a low, and a low. Of course, when we're following traditional price movement, a trend is deemed to be when there's higher highs and higher lows, because the trend will always move in what is known as waves, also known as impulse waves and corrective waves. So when we're looking at that and we're looking at the markets like so, and we see the price starts to increase as well, I may think about opening a trade here. So what is a stop loss, a take profit, and a trailing stop? These are automatic orders within the market. This is how it's officially known. What is an order? Think about it as a tool, okay, which you can apply to that trade, to that investment, okay? So let's say, for example, here at this line, I'm going to speculate the price is going to increase in value, okay? I can say, let's say at this price here, the stock is worth 100 US dollars. Please ignore my handwriting, I'm using a computer mouse. Let's say it's worth 100 US dollars. You can place a stop loss and a take profit. Now, what is a stop loss? Stop loss is when you come to the market and you say, I've opened this trade, but if the price drops to $90 here, okay, I want you to automatically close the trade and I want you to cash in my $90 back into my account, all right? So you're risking no more than $10. So if for whatever reason the price does decline all the way down to here, it will automatically close your trade and put $90 back into your account, okay? So this is also why I said on the slide before, nothing should ever be a shock for you. You shouldn't be putting a stop loss at $90 and saying, oh my God, I can't believe that happened. It's a shock. Why have I lost that money? That should never ever happen within the market. Then a take profit is very simple to understand as well. It's another tool which you say to yourself, for example, here at $130, okay? You say if the price keeps on increasing and goes up to that price, again, when we reach this price here, close the trade, put my $100 which I invested back into my account, plus my $30 profit. And it will automatically do so, whether you're on the computer or not, whether you're sleeping, whether you're on holiday, in the swimming pool, whatever it may be, it will close the trade for you and cash in that for you. Now, what is a trailing stop? A stop loss, ladies and gentlemen, will remain static. It will remain the same. So if I open a trade here, okay, and I put a stop loss here, if the price increases in value, my stop loss will remain at the same price. It will never, ever move. But a trailing stop will keep moving up with the price. So a trailing stop is slightly different. It won't say at what price do you want the stop to be. It will say how much lower than the current price do you want the stop to be. Okay, so for example, let's clear up the diagram so I can show you again. Let's say the current price is here at $100. Okay, I will put a trailing stop, okay, at $10 below, okay? So this is at $90. But let's say the price increases. The price has increased all the way up to here, and it's increased to $200, okay? This means my trailing stop is now at $190, okay? So the price of the trailing stop has also increased. So it's not only protecting me against a significant amount of loss, but it's also, if the price increases in my favor, it starts to protect my profit as well. So if the price then drops from 200 to 190, it will close the trade automatically. Okay, and it will put in my account the $100 plus the $90 profit as well. So a trailing stop, as the price increases, will continue to increase with it. Whereas a stop loss, as the price increases, the stop loss will remain the same. Okay, so this is the difference between stop loss and a trailing stop. Both are very useful, of course. The trailing stop is slightly more useful in certain aspects. It does have some disadvantages, but it is slightly more useful in the fact that it can also protect your profit as well. The next thing, are you using the right amount of leverage? Now, you have to understand leverage if you're going to think about risk. Now, some people are going to say to me, I'm only putting in a very small amount of capital. I'm only putting in $50. I'm only putting in $100 or $30, whatever it may be. So I need very high leverage. I need the highest leverage possible. Okay, that's understandable. I'm not going to sway you away from that. There's nothing wrong with using leverage as long as you're using it responsibly. Now, what is leverage? Leverage is basically increasing your buying power. So you can buy more expensive assets or trade more with less. But what happens is there's a lot of volatility in the market because of leverage. So let's look at an example, okay? Let's say I've got leverage of 1 to 10. So this means for every $1 that I invest, it's actually moving like it's $10. Okay, so if I want to buy a stock worth $100, I don't have to spend $100. I only have to invest $10. Okay, but if the stock declines to $90, if I didn't use leverage, I would have lost 10% because it declined by $10. Whereas if I've got a leverage of 1 to 10, the stock has declined by $90, so $10, and my investment is now at zero. Why? Because I'm using leverage, because I've got $10 and I bought a stock worth $100. So if it declines by $10, I only had $10 in the account. So it's now at zero, right? So we still need to take volatility and leverage into consideration. So make sure, because there is of course a lot of advantages to leverage. I'm not denying that. There is a lot of advantages to leverage, but we have to use it responsibly. Okay. If anybody's got questions about leverage, of course they can ask as many questions as they like. So next point number 4. Apologize, I'm just taking off my jacket here. So the next thing I wanted to mention is margin level. What is margin level? You will see it on the MT5 as well. Got a lot of people popping up saying, can we go to the mathematical slide? It's in about 2 slides, not long left. And we've only got 2 points on this slide. So margin level, this is very important when using leverage. What is margin level? It's basically equity divided by used margin times 100, and it will give you the margin level. Now, what does that mean exactly? What is equity? Equity is the money you put into your account plus any profit and loss. Okay, this is equity. So if I invest 1,000 and I've made a profit of 100, my equity is 1,100. Very simple to understand. Used margin. Used margin is anything which is exposed to the market plus any profit and loss. Okay. So why is this important? Because the lower the leverage is, the more you are, the lower the margin level is, the more you are exposed to the market. So you have to understand that. We are going to look at exposure as well towards the end of the webinar. Now, what we need to take into consideration is when the margin is low, you may potentially get a margin call. Now, what is a margin call? A margin call will be an email, and it will come to you and say to you, you have 3 options. you are very close to running out of capital because you've opened so many trades and all of them are moving against you, most likely. This is also why another reason, I said at the very beginning, trade one asset, because it's more manageable. Doesn't mean you earn less. Some people think the more different assets I trade, the more I'm going to earn. Doesn't mean that in any way, shape, or form. You can trade more and trade one asset. But anyway, when you get a margin call, you will be given three options. Will be given either you add more money to give your trades more time, or you can close some trades to free up money, so it's not exposed to the market, so you're lowering your exposure. Or point number three, you can do nothing. You can wait and see the market starts to move in your favor, because if it starts to move in your favor, of course it frees up money because it's profit. Now, a lot of people say to me as part of the risk management webinars, what should I do? Because I'm given three options, I don't know which options to do. If you are 100% confident that all of those trades which you have open, most likely there's a lot of trades, if you're getting a margin call, if you're confident all of those trades are going to be profitable, and it's not about them being profitable in a year's time, it's useless if it's going to be profitable in a year's time. We're trading, so it needs to be profitable imminently. It needs to be profitable very, very soon. If you think it's going to be profitable, all of those trades, then of course it makes sense to add money to give it more time, if that is what you believe. If you believe some of those will be profitable and some of those will not, then it's a scenario of, you look at all your trades that you have open. You've got, let's say, trades like this, okay? You look at the trades and you say, this is in a minus. Do I think that's going to move in my favor? No. Close it, because when you close it, you freeing up capital. This trade, do I think it's going to turn into a profit? Yes. Okay, keep it. This trade, is it going to turn into a profit? Yes. Okay, keep it. Will this? No. Will this? No. Will this? No. This one? Yes. This one? Yes. Okay. So I've closed 4 trades. Because I've closed 4 trades, I've freed up capital. So I've avoided that margin call. So there's 3 things for you to do. If you think your trades, all of them will move into profit, there's a couple of things you can do. You can either add money to give them time, or you can do nothing. If you think they're going to move right away, very soon, maybe related to, for example, news, into your favor, then you can do nothing. So there's 2 options. If you think some of those are not going to be in a profit and going to keep moving against you, close them. It frees up margin, it solves the issue. Last thing, don't fight the trend. A lot of people say, why am I unsuccessful? I invested 10,000, I'm now at 7,000. Why have I lost 3,000? We look at the trade and, we're seeing an upward trend like this, okay? And they enter the buy here. The market, though, did this. They didn't close the trade, all right? And then the market declined again, and then they opened another buy here. And the price still is declining. And they say to me, why have I lost? Why am I losing? You're fighting the trend, okay? When you're trading, it's about trading in the direction of the market, because you're trading, you're not building a portfolio. So not only you've missed out all this opportunity, look at all this, you could have closed this trade and traded all of this downward price movement, but you're not, you're fighting the trend, and you're not going to win because everybody's selling, which is causing the price to decline, and you're sitting there buying. Okay, so it's important you have the discipline, and this is part of risk management, to say the market's moved against me, close the trade. It doesn't matter that I've lost $10. The price is going to keep on declining. I've lost $10, but let's make $20, $30, $40, $50 over the next 2 weeks as the price is declining. Why am I going to sit there for 2 weeks as the price declines against me? Okay, this is something for you to take into consideration. The only reason that you should keep that trade open is if you think it's going to straight away move in your favor. Some people said to me, I think at some point it's going to go back into our favor. What does some point mean? I say to them, when do you think it's going to move in your favor? In May, in June? Because if you think it's going to move into your favor in May and June, you're going to sit there now for 4 months as the market moves against you, when you could be taking advantage of that price movement. Okay, so take this into consideration. Don't fight the trend. At least as beginners, don't fight the trend. I've got another question. Let's move over to the next slide and then we'll look at this question. He says, what's your advice? Keep in mind, we don't give advice. We can give information for educational purposes, but not advice. What's your take on opening higher lot sizes and opening more positions on your trade? There's a couple of things I will say about this, ladies and gentlemen. Number one, how much exposure is more trades and higher trades? This is the first thing. If you're, because of it, more exposed, then it's an issue why you're going to do it. The next thing is it all on the same asset? Because if it's not, are you going to be able to manage this? We have to take this into consideration as well. If it's all on one asset, then okay, fair enough. The next thing, are you a successful trader? If you're not a successful trader, why are you going to increase the trade size and open more trades? If you're not a successful trader, this is another thing to take into consideration. Now, what we are going to look at, I think it's on the next slide, is how you can mitigate the risk and lower risk through opening more trades. Okay, but this is something we're going to look on the next slide. I think you'll find it very interesting. So this is on this slide here, I want to look at, because we had a lot of questions about this yesterday. What is your entry, and is your entry creating higher risk? Is it limiting the chances of you earning a profit? Because what a lot of people do, it's not your fault that you do it, because there's a lot of so-called educators, and I guarantee you none of these educators have ever been profitable. None of them have ever worked for large institutions. So be really cautious about who you're getting education from. If you look at, for example, these videos, they say to people, we have the impulse wave, we have the corrective wave, this is the high, and then we should trade above this level, because if we've gone to a higher high, it means it's a trend. It's not incorrect, but what I will say to you is, if you're trading above this level here, then you've missed most of the price movement. Okay, you've missed maybe 50%, you may miss maybe 60%. So why would you trade when you're limiting the possibility of profit? Because if you're trading very close to the end of the impulse wave here, which most likely you are, if you're trading after the breakout, then you're limiting your chances of profit because you've missed most of the price movement. You're sitting there and waiting and waiting and waiting and waiting until we get a higher high and then trade it, but it's too late because we're about to form another retracement. If it's a trend, it's not such a big issue because eventually the price will move in your favor. But why would you trade, for example, in this area of the market here when you're about to witness a retracement? Isn't it not better to trade in this area of the market here? All right, so how exactly can we do this, ladies and gentlemen? And I've got a real example here. This is the New Zealand dollar against the US dollar. Here is the low. I've drawn a orange line here for the low. So people are starting to say, after we cross to a lower low, this is when you should start trading. This price movement here, okay, I've measured it for you, is 0.35%. All right, this price movement here is 0.27%. Okay, the next question is, ladies and gentlemen, are you going to be so accurate with your entry that you're going to enter at this exact line? Or most of the time, are you going to be most likely late and trade somewhere here, in which case it's not even 0.27%, it's more like 0.22, which is nothing compared to 0.35. So why miss most of the price movement? Why try and take advantage earlier so you've got a higher possibility of earning a profit? So yes, you can take into consideration higher highs and higher lows. So, we've got one high like this. So we've had that first impulse wave, okay? I know that's going to retrace. It may retrace today, maybe tonight, maybe tomorrow morning. Doesn't matter when. I know it's going to retrace. So as it retraces like this, okay, if it's a trend, I know it's going to move up, okay? So as soon as we get some volatility like this, I know that it's potentially going to do something like this. So why wait for this moment up here when you can take advantage of it earlier on, okay? Now, this is, of course, only something you take into consideration if you're sure it's a trend. So is there something fundamentally driving the trend? Is there a higher high? And so on and so forth, okay? I've got another question, so let's answer this question before moving on. Order flow analysis, how do you get access to order flow analysis? The MT5 will not show it, no. So if you go to Google and type in order flow charts, okay, order flow analysis, anything like this, it gives a lot of options for you, okay? Very simple. Some order flow analysis tools are available on the MT5, and you can download some which are available on the MT5, but you can get access to it through other means as well. Scaling in and scaling out. So this is about opening more trades. So take this into consideration, ladies and gentlemen, because we're looking at on this slide, our entry, okay? Now there's an option which we could use to mitigate the risk and spread the risk of the price which we are entering and the time we are entering. So somebody's already mentioned, can we trade more trades? And yes, you can. It's known as, you can either do three things: scale in and scale out, or you can just scale out or just scale in. Okay, so what is scaling in? Scaling in is when you say to yourself, I believe the price is going to increase. And instead of opening one trade here, and I'm opening one lot, okay, here, I'm not going to do that, all right? Instead of doing that, I am going to open a trade here, and I'm going to open 0.25 lots, okay? And then at this price, I will open another 0.25 lots, and then this price, I will open another 0.25 lots, and then this price, again, another 0.25 lots, okay? This is an option. So what you're doing is you're mitigating the risk, you're spreading the risk across different times and different entry points, okay? And then you've got one target for all of them, okay? Because you're not scaling out, you're only scaling in. So you're opening different trades at different times, all of them with the same target, okay? Instead of opening one large trade at one price, in which case you better get the price right and the timing right. But if you've got a zone, okay, between this time and this time and this price and this price, of course you are spreading the risk and you're lowering the risk as well. So let's look at an example of that. This is just an example. Let's say we've got an impulse wave and then it started to retrace downwards, but I think it's going to continue, and I've got a target up here. I may open a buy here, I may open a buy here, and a buy here as well, all right? So, even if I open a buy here and the price keeps moving against me, I've got a second possibility and a third possibility. So even if it does something like this, okay, I've mitigated the risk, okay? Whereas if I opened a larger trade on point number one here, I would have seen a much larger loss as the price is moving against me, okay? And I've got the same target here. Option number two is that we open one large trade here, or even multiple trades, but all on the same price. We have different targets to exit. So exit here, exit the next trade here, exit the next trade here. So I'm scaling out. Next option is scaling in and scaling out, right? This can potentially lower the risk of certain trades. I've got another question here. Can you give me some examples of order flow? Ah, this is from another person. Something that you can research is, for example, order flow charts. If you type in order flow charts, if you type in delta statistics, cumulative delta, volume weighted average price, things like this, okay? So this is a calculator on our chart, on our website. You know, we provide so many tools available for traders. This is a great calculator, because what it's saying is, you know, it says to you what's price are you opening your trade, and let's look at different targets. So you're able to scale out. So here, for example, I'm trading shorts and trading the euro against the US dollar. At this price, I've opened this lot, and I've got target 1, target 2, target 3, and it shows how much I'm going to close at each price. And I'll say to you, at target 1, you earned 67. At target 2, you earned 96. Target 3, you earned 149, and so on and so forth. Okay, so this is again something that you can use as well. Right, so this is a slide everybody has been waiting for. So let's look at this, okay? RR and success rate. What exactly is this? Let's start off with the success rate. It's very easy to understand. I've got another question. Let's quickly answer that. What app website may we use to help calculate the risk to help us set our stop loss? You can use our website. If you go to our website, go on tools, and then go on calculators, there's a risk calculator there. There's actually different options, but there's a few calculators you can use. There is also a risk calculator, though. That is one of the options. Also, if you're using your mobile, if you click stop loss and put a price in, even if you're not going to carry on with the stop loss, it will show you how much in terms of money is that stop loss. So if you're thinking about, you know, exiting at this price, put it in a stop loss, and it'll say to you, if it declines to that, you will lose $10, for example. So you can use that to take into consideration as well. Now, success rate. What is success rate? Success rate is what is the percentage of trades that you're opening being closed in a profit and being closed in a loss. So for example, if I open every single week 10 trades, and every single week have 5 trades I close in a profit and 5 trades I close in a loss, I've got a 50% success rate. Very simple to understand. RR stands for reward to risk ratio. So it means how much am I looking to earn, how much am I looking to lose. Now, what I will say to people is risk management and trade management, money management, everything will be easier if everything's always the same. So if one day you're opening 1 lot, the next day you're opening 0.0 lot, 0.01 lot, and every single day you're opening a different size, and every single day you've got a different reward to risk ratio, and of course management is going to be very difficult, and mathematically there's no way in which case you can use it because every single day is different. So keep in mind, try and always have the same trade size, same assets, same sessions, and also the same reward to risk ratio. What is the reward to risk ratio, ladies and gentlemen? Let's say you're looking to earn $10, okay, and you're looking to risk $5 per trade, okay? That very simply means you have a 2-to-1 reward to risk ratio. This is very simple to understand. So hopefully everybody understands the success rate and reward to risk ratio. Now, what do we need in order to determine what mathematically needs to be done in order for me to be profitable? We need to know our success rate. We need to know how many trades we open every single week. And we need to know what our reward to risk ratio is. Okay? If we don't have a reward to risk ratio yet, because we may be a beginner trader, then we can use this to determine what the reward to risk ratio needs to be. So let's look at different examples, because you're going to get a good example now, a good idea now of how to use this. Let's say we've got John. Okay, John has 30 trades per week. Every single week he opens 30 trades. He's got a reward to risk ratio of 2 to 1. So that basically means he's going to look to earn $30 per trade and risk $20 per trade. It's never anything different, and he always opens 30 trades per week. His success rate is 67%. So that means, ladies and gentlemen, he had 10 trades in a loss and 20 trades in a profit. So very simply, that means, and you've got to think of it as a business. This is why I've said turnover and expenses, because that means, ladies and gentlemen, his turnover or his profitable trades is $800, because of course it's 40 divided by 20. Okay, and his expenses, which is his losing trades, is 200 because it's 10 times 20. Okay, so 200. So his profit at the end of the week is 600. Okay, so he can see there mathematically he's successful as a trader. Okay, let's look at point number 2. You're not going to quite understand yet, but you are going to understand in a minute. Let's look at point number 2. This gentleman, his name is Jude. For example, like the actor Jude Law. 30 trades per week as well. He's opening the same amount of trades. He has a reward to risk ratio of 1 to 5. So he has a negative reward to risk ratio. It means he's looking to earn less than what he's risking per trade. So per trade, he wants to earn $10, but he's willing to lose per trade $50. People are probably thinking that's crazy. Why would he do that? He's given himself more time within the market. It's allowing more volatility in order to earn a profit. It's not an issue as long as it means he has a high enough success rate. Because he's given himself more time and volatility allowance in the market, he has a success rate of 90%. So that means he only loses 3 trades, and he's earning a profit at 27 trades. So his turnover is 270, and his expenses, losing trades, is 150. So he's in a profit every single week of 120. So even though he has a negative reward to risk ratio, because it's a negative reward to risk ratio, it has triggered a high success rate, which means he's still profitable. Then let's say we've got somebody else. Here we've got Mary, still opening 30 trades per week. Okay, she has a high reward to risk ratio. So she's got a reward to risk ratio of 4 to 1. This means that she's looking to earn $32 and she's looking to risk $8. So she has a success rate, ladies and gentlemen, of 35%. So she's terrible at trading. Most of her trades end up in a loss. Okay, she's terrible at trading. She's only correct 35% of the time. She may be a beginner trader. But because her reward to risk ratio is so high, she's still profitable. Because based on this, she's looking to earn $11 and she's looking to risk $19. Sorry, she's looking to earn $32 and looking to risk $8. That means, based on 35% success rate, 11 trades are in a profit, 19 trades are in a loss. So more than half. But because she has a high reward to risk ratio, 363% of the time, $363 in profit, 152 in a loss. So she's in profit 152. Okay, that's more than somebody with a high success rate. Okay, so what I'm trying to say here, ladies and gentlemen, it doesn't matter if you have a high success rate or a low success rate. What matters is mathematically you putting yourself correctly within the market in terms of how much am I looking to earn, how much am I looking to risk in terms of money. If I'm looking to earn $10, this is how much I need to be willing to risk, okay, based on this amount of trades and this amount, this success rate. So go back to your trade history, look at your success rates every single week, take it week by week, look at how many trades you're opening, and look at what needs to be earned and lost on each trade in order for you to be successful, okay? Because I've proven to you here that somebody with a low success rate or high success rate or a negative reward to risk ratio can still be successful. Nobody ever looks at this, okay? I've got a lot of questions and a lot of comments. I can see comments popping up. This is blowing my mind. Yes, okay. And I've got some questions as well. So let's look at the questions. Mary's profit is 200. Correct. Apologies. You are correct. Slightly over 200. Still profitable. Okay, that's the main thing. Are all trades on the same asset or diversified assets? When you're trading CFDs, it's not the same as portfolio. When you're building a portfolio, people say to diversify, okay? Because a portfolio, you buy assets and you're keeping it there, and it's a longer term investment. So you need to diversify because you don't know what's going to happen in a year's time. But when you're trading, you're not building a portfolio. CFDs are not designed for building a portfolio. You're looking to enter and exit the market with leverage and a lot of volatility. So when you diversify, okay, you're not actually diversifying, you're just making it more difficult for yourself because there's a million different things that you have to manage, okay? Because you are consistently entering and exiting, entering and exiting. Whereas when you build a portfolio, you buy and you sit on it. And then maybe you'll buy next month, or maybe you'll buy again after 6 months, and so on and so forth. It's less active. So when we say diversify, a lot of the time, you know, financial advisors, they're referring to building a portfolio. You can diversify with CFDs, of course that is correct, but you're not going to diversify by trading a million different assets, okay? That's just going to make trading more difficult for you. Okay, so I can see those are all the questions answered. Let's go to the next slide as well. I want to point something out to you. Always review your trades, okay? We've been speaking now for just over an hour. We're going to end the webinar in a moment or two. Always review your trade. So how do you know if you can change your reward to risk ratio? So let's say you look at your success rate, you look at your reward to risk ratio, and you say, you know, I've got a success rate of 50%, for example. I'm looking to earn per trade $50, and I'm risking per trade $65. Okay, so I'm unsuccessful. I can see that I'm unsuccessful. I've been trading for 2 months and I can see I'm unsuccessful. My success rate isn't improving at the moment. So something needs to change in order for me to be profitable. Look at your trades and see if you can allow more risk and see if you can allow a further away target. So let me give you an example. I'm trading. Look at all your profitable trades, all the trades that you ended in a profit. So your analysis was correct, okay? So here, for example, we're trading a trend. We trade looking at the assets, the trades where you are profitable and you successfully analyze the market. You entered here and you exited the market here. Now, if every single occasion where you got the market and the analysis and the trade correct, you could have kept hold of the trade after that on every single occasion, or maybe on 95% of the time. Why not consider increasing your target? Okay, why not do so? If on every single time you are correct, you could have kept hold of the trade for longer, why not consider doing so? Because a lot of people I speak to, they trade, and they never go back and review the trades, every single trade at the end of the week. They never go back and review all of their successful trades and all of their unsuccessful trades. Because the idea of this, which is a big part of risk management, is to improve your trading and your trades. So go back, look at all the successful trades from this week and say to yourselves, could you have kept open the trade for longer? If you open the trade here, okay, and you are closing the trade here at this green line, and the market does something like this, no, you definitely cannot. So don't take it into consideration. So this is one thing. Next thing, look at all your closing trades which you ended in a loss. Let's say you bought here, okay, and you closed the market here, but after the market moved in your favor. What does that say to you? You could have kept hold of the trade slightly longer, okay, and the market would have gone into your favor. So potentially take into consideration allowing more volatility within the market, only if on every occasion, this is the scenario, this is the occasion only on 30% of the time, then of course that's not a smart move, okay? So you can see here exactly how I'm using mathematics, okay, and my trades and my trade reality to improve my trading. This also, ladies and gentlemen, is part of building a trade journal, which is, we're looking at every single trade that we're trading. And another thing I would say is never give up on your asset. A lot of people say, I've been trading for a week, I'm not earning any money, let's trade a different asset. That's not going to help, okay? Let's move on. Analysis and risk management. There is 3 main types of analysis. Ideally, you should be using all 3, okay? Everybody can trade on HFM's platform on the MT5 and do all of these 3 analysis, okay? Of course, not everything is on the MT5. You can't do fundamental analysis on the MT5, but you're of course still trading on the MT5 or on HFM's mobile app, whatever it may be. But you should be spreading the risk through all types of analysis, these 3. So nobody should necessarily just say, I'm going to only focus on technical analysis, because you may be opening times at a certain point and then news is released and then the market just very quickly moves against you. You want to avoid that. You can do that through risk management by using all 3 types of risk management, all 3 types of analysis. So technical analysis, we're not going to go through all of them in depth because it's not a webinar about analysis. We've got other webinars about analysis that you can join and watch. So technical analysis is the analysis of the price, of signals and indicators, okay? Technical indicators. Fundamental analysis is the analysis of what is triggering individuals to buy and sell. Because of course, the price is developed and dependent on buyers and sellers. So fundamental analysis is looking at what's triggering them to buy and sell. And order flow is basically looking at orders, looking at how many people are buying, how many people are selling, where they're buying, where they're selling, and so on and so forth. So you want to mitigate the risk. Now, ladies and gentlemen, we're on our last slide. The last thing I will say about exposure, which doing a quick recap. Last thing I'll say about exposure is consider the 1% rule. It's a very well-known rule. Go to Google, type in the 1% rule. It will come up. Try not to get overexposed. In order to not get overexposed, when you're opening trades, let's say you've got 10,000 euro account, that trade shouldn't be more, or your trades shouldn't be more than $100 margin. Okay, this will confirm you're not overexposed, and the market is going to allow you. Your account is going to allow the market time. No conflicting signals. If you're analyzing the market, some things are saying buy, some things are saying sell. They're conflicting, which means there's a higher risk. Unless you're willing to risk it, if you are 100% fine. But in terms of risk management, there's a higher risk when you have conflicting signals. Ideally, you want all signals to be pointed in the same direction. I mentioned this a couple of webinars ago about currencies. When you're trading and analyzing a currency pair, a currency pair, ladies and gentlemen, is one asset, okay? And we analyze it as one asset, but in addition to this, analyze each currency individually as well. So analyze the euro against the US dollar, but also analyze the euro and also analyze the US dollar. And ideally, you don't want them to be conflicted. So ideally, we don't want the euro to be increasing against all currencies and the US dollar to be increasing against all currency. And then we've got that tug of war scenario. Ideally, we want one currency to be declining and the other currency to be increasing against the whole of the market. Ensure you are aware of the outcome of each trade. Stop loss, take profits, trailing stops, knowing when to enter, when to exit, even before you do. Are you entering at the right point within the trend? We looked at that. Yes, we can consider the breakout, but we're missing out most of the price movement. Think about what's a more competitive area to enter the market. Do not fight the trend. The market moves against you. Consider closing unless you think it's going to imminently move back in your favor. Very, very important, reward to risk ratio and success rate. Now, ladies and gentlemen, we've been speaking now for an hour and 15 minutes almost. So I don't want to spend too much of everybody's time. I don't want to give you so much information that it's going to be very difficult for you to take it all in. But I will allow 2 more minutes if anybody has questions. If anybody has questions, feel free to ask now. Otherwise, we'll end the webinar. Any questions, ladies and gentlemen? The recording, of course, will be available as always. Okay, I can see a lot of thank yous and feedbacks, etc. So it sounds like everybody's fully aware and understood and doesn't have any questions. So let's end today's webinar. Trade safe, trade responsibly, ladies and gentlemen, and hopefully we'll see you very soon on our next webinar. In the meantime, goodbye, have a good evening, and we'll speak again very soon on the next webinar. Goodbye, ladies and gentlemen.